Two headlines went viral this year, and they cannot both be true. The first, the petrodollar is dead. The 50-year agreement finally expired, and the dollar's grip on oil is over. The second, quieter one, the dollar is still on one side of nearly 9 out of every 10 currency trades on Earth, and oil is still priced in it. One says collapse, one says business as usual, and your entire read on the world economy depends on which is right. Here is the problem. To know that, you first have to understand what the petrodollar actually is, and almost everyone selling you the collapse gets it wrong in the very first sentence. There was no secret treaty, there was no expiry date, but there is real erosion, just not the kind you were promised. So let us take the whole system apart, myth by myth, and rebuild it from the facts, because the honest answer is more interesting than either headline.
The word itself. Petrodollar is not a currency. There's no special note printed for oil. It is a nickname for a pattern with two moving parts. The first, when nations buy and sell crude oil, they overwhelmingly price it and pay for it in US dollars. A tanker leaving the Gulf bound for India or Japan is almost always invoiced in dollars, regardless of who is buying or who is selling. The second part closes the loop. Oil exporters, Saudi Arabia, the Gulf states, earn enormous piles of those dollars, far more than they can ever spend at home. So they recycle them. They park them back inside the United States, mostly by buying US Treasury bonds and other American assets. Dollars flow out for oil, dollars flow back in as investment. That circular flow is the petrodollar system. Now, notice what it is not. It is not a law. It is not a signed obligation that anyone can cancel. It is a habit, an enormously sticky one, held in place by what economists call network effects. And to understand why it is so sticky and whether it can break, you first have to kill two myths that have poisoned this entire subject.
Myth number one is the origin story you have heard 100 times, that in 1974, America and Saudi Arabia signed a secret pact. The Saudis would price all their oil in dollars, and in exchange, America would protect the kingdom. It sounds airtight. It is also not what happened. Go to the primary record, the US State Department's own Office of the Historian, and here is what 1974 actually produced. On June 8th, the two countries created JECOR, the Joint Commission on Economic Cooperation. Its job was industrialization, trade, science, and technology, helping Saudi Arabia spend its oil wealth on development. Read the founding documents, and there is no clause requiring oil be priced in dollars. None. Separately, that summer, Treasury Secretary William Simon flew to Jeddah and struck a different deal. The Saudis would quietly invest their oil revenue into US Treasury bonds, and the kingdom demanded it be kept strictly secret. It stayed secret for 41 years, until Bloomberg pried it loose with a Freedom of Information request in 2016. So 1974 produced two arrangements. Neither one mandated that oil be sold in dollars. The secret pact that supposedly forces the world to price crude in dollars simply is not in the record. So if no treaty forced it, why is oil priced in dollars, and has been for 50 years? The honest answer is less dramatic than a secret pact, and far more powerful. It is the network effect. By 1974, the dollar was already the world's dominant money. After the Second World War, the United States held most of the planet's gold and ran the deepest, most liquid financial markets on Earth. When you sell something as valuable and as globally traded as oil, you want to be paid in the one currency everyone else already accepts, holds, and trusts. The currency with the biggest, safest bond market to store your earnings in. That was the dollar, and it still is. Two more quiet reinforcements. Saudi Arabia pegs its currency, the rial, directly to the dollar, so pricing oil in dollars keeps its books simple. And here is the detail that quietly demolishes the treaty myth. Saudi Arabia actually kept selling some of its oil for British pounds well into late 1974, after the supposed dollar pact was signed. The world converged on the dollar not because a document commanded it, but because once nearly everyone is using one currency, it becomes costly and pointless to be the one who does not. That is a habit, and habits can loosen.
Which brings us to myth number 2, the one that went viral in 2024 and is still circulating today. In June of that year, posts exploded across social media, claiming that a 50-year petrodollar agreement had expired on June 9, 2024, and that Saudi Arabia was now free to sell oil in any currency it liked. The dollar's oil era, they said, had just ended on a specific date. It was completely false, and it was debunked on the record by the people whose job is to check. PolitiFact investigated and rated it false. There was, in their words, no formal agreement that Saudi oil had to be sold in dollars, so there was nothing to expire. Radio Free Asia's Asia Fact Check Lab went further. They got a US Government Accountability Office official to confirm on the record that the 1974 commission contained no agreement on oil being traded in dollars, and that no such document exists at all. So here is what the hoax actually did. It took the real JECOR agreement from 1974, invented a 50-year sunset clause that was never in it, and glued a dramatic expiry date onto the front page. A fake deadline bolted to a real document that said nothing of the kind. Now you are inoculated against both myths, which is exactly why the next part matters.
Now, if I stopped here, I would be lying to you by omission. Because while the myths are false, the erosion is real. This is where the honest version parts ways with the dollar cheerleaders. Start with reserves, the money that central banks hold in their vaults. According to the International Monetary Fund's official reserve survey, as of the first quarter of 2026, the US dollar makes up about 57% of the world's allocated foreign exchange reserves. Hold on to that word, reserves, because we will meet very different numbers in a moment. 2 decades ago, that figure was about 72%. So over roughly 20 years, the dollar's share of global reserves has slid from about 72% to about 57%. Not a crash, a steady, grinding decline. And where is that money going? Not mainly into the euro, and not mainly into the Chinese yuan. A striking share is going into gold. In 2025, the world's central banks bought roughly 863 tons of gold, the 4th largest year on record, after 3 straight years of buying more than 1,000 tons each. Central banks do not pile into gold when they feel certain about the dollar. That is real. That is a signal worth taking seriously. The question is what it actually means.
So where is oil actually trading outside the dollar? Real cases exist, but look closely at where and why. The biggest is Russia. After it invaded Ukraine in 2022, Western sanctions cut Russia off from the dollar system. It was pushed off the dollar, not walking away by choice. So Russian oil started settling in Chinese yuan, in UAE dirhams, in Indian rupees. India, which barely touched Russian crude before the war, now buys so much that Russian oil is around 40% of its oil imports. And in 2025, India resumed paying for some of it in yuan. Meanwhile, China and Saudi Arabia have laid groundwork. A first trade settled in digital yuan, a roughly $7 billion swap line between their central banks, and Saudi Arabia joining an experimental payment network called mBridge. It sounds like momentum. But now, the other half. This shift is small. It is largely sanctions-driven, and in places it is already stalling. Russia ended up holding piles of Indian rupees it could not easily spend. The Bank for International Settlements, which built mBridge, quietly withdrew from the project in October 2024. And Saudi Arabia was only invited to join the BRICS group. It has never actually confirmed membership.
This is diversification at the margins, driven by sanctions and hedging, not a new financial order arriving.
So why doesn't the whole thing just break? Because underneath that eroding reserve share sits a moat no rival can cross yet. And here, the denominators matter most. Reserves are only one measure. Look at daily currency trading, and the dollar is on one side of about 88% of all foreign exchange transactions on Earth, a figure that has barely moved in 20 years. Look at trade invoicing, the currency written on actual contracts, and the dollar is roughly half of all global trade, far beyond America's share of the world economy. And oil is still overwhelmingly priced and paid in dollars. But here is the single fact that holds the whole system up. When oil exporters or China or anyone else earns dollars, they need somewhere vast and safe to park them. That place is the US Treasury market, nearly $30 trillion of government bonds, with more than $1 trillion changing hands every single day. No other country has a safe asset market anywhere near that deep. The obvious challenger, China's yuan, is capped by China's own capital controls and the fact that it is not freely convertible. Money cannot move in and out of China at will. That is why, despite every headline, the yuan is still only about 2% of global reserves. There is simply no vault big enough to replace the dollars. Not yet. So put both halves of the ledger on the table, and here is the honest verdict. Are the cracks real? Yes. The dollar's share of global reserves has genuinely fallen from about 72% to about 57%. Central banks are buying gold at a pace we have not seen in generations. Real oil is now settling in yuan and rupees at the sanctioned margins of the world. None of that is propaganda. It is measured, dated fact. But is the petrodollar system about to break? No, and not close. The dollar is still on one side of about 88% of all currency trades, still invoices about half of world trade, still prices nearly all of the world's oil, and still rests on a bond market no rival can match. What we are watching is not a collapse, and it is not the coronation of some successor currency, because there is no successor ready. What we are watching is diversification, a world that grew uncomfortable being 90+% dependent on one currency, slowly hedging its bets, trimming an overconcentration. The right word for the dollar's position is not doomed, it is constrained. This is erosion measured in decades, not an expiry stamped on a single day in June.
So, the next time a headline tells you the petrodollar just died on some exact date, you will know what to do with it. There is no single agreement to expire, because there never was one. The system is a habit, held up by network effects, and habits that large do not vanish overnight. They erode, slowly, and you can watch them erode. So here is what to actually watch. Not a collapse date, but two quiet trend lines. The dollar's share of global reserves, ticking down a point or two a year, and the tonnage of gold that central banks keep buying. Tracked over years, those two lines will tell you far more than any viral post ever will. If you want the rest of this machine, who really owns America's debt? What actually moves the price of oil? Why central banks are hoarding gold in the first place? Those breakdowns are waiting in the catalog, each built the same way: calm, sourced, and non-partisan. One last note, the same as always. This is an explanation of how the system works, not financial advice and not a prediction of collapse. This has been Money and Power Explained. Follow the money. It always leads to power.